In the early months of 2022, following Russia's invasion of Ukraine, Western powers led by the United States and the European Union unleashed what was expected to be the most crippling series of economic sanctions in modern history. These measures aimed to isolate Russia, disrupt its financial system, and degrade its ability to fund the war effort. From targeting individuals and businesses to banning Russian aircraft from European skies and removing key Russian banks from the SWIFT payment system, the sanctions were meant to cripple Russia's economy. But contrary to expectations, Russia's economy did not collapse. In fact, by the end of 2023, Russia had outperformed many major economies, including those of the G7. Grocery stores in Moscow remained stocked, prices stayed relatively stable, and the ruble, far from collapsing, recovered after an initial dip. How did Russia manage to defy the economic punishment of the West? This video delves into the multifaceted strategies Russia employed to survive and thrive in the face of sanctions. From pivoting to a wartime economy to reorienting its trade and financial systems, Russia's resilience in the face of global economic warfare is a remarkable case study. It also points to a broader shift in the global order, the rise of a multipolar world where Western powers can no longer singularly dictate the course of international economics and politics. By 2024, over 16,000 sanctions had been imposed on Russia. These sanctions targeted various sectors. Individuals. More than 11,000 sanctions were aimed at key individuals, including politicians, oligarchs, and members of the Kremlin's inner circle. The goal was to weaken the power structure surrounding President Vladimir Putin and create internal pressure. Entities. Around 4,600 sanctions were directed at Russian businesses, including financial institutions, energy companies, and defense contractors. The hope was to suffocate Russian industries, especially those related to energy exports, which formed the backbone of the Russian economy. Assets and transportation. Sanctions were also imposed on Russian-owned assets such as ships and aircraft. European airspace was closed to Russian planes, significantly disrupting logistics and travel. The West expected these sanctions to trigger widespread economic chaos within Russia. Initial predictions suggested that the ruble would collapse, inflation would spiral out of control, and the economy would grind to a halt as imports dried up and industries faced shortages of critical components. But none of these predictions materialized as expected. While there was a brief period of instability in the early months, the Russian economy rebounded quickly. Prices stabilized, and Russia's key industries, including energy production and arms manufacturing, continued to function. One of the critical factors behind Russia's economic resilience was its pivot to a wartime economy. For the first time in modern history, Russia dramatically increased its defense spending, redirecting much of its GDP toward military and strategic needs. By 2024, Russia was spending 6% of its GDP on defense, an enormous sum compared to most developed nations. Defense spending had officially overtaken social spending in the national budget. This wartime footing ensured that critical industries related to defense, such as arms manufacturing, aerospace, and technology sectors, remained fully operational. Ironically, the war in Ukraine became the primary driver of Russia's economic activity. The need for arms, ammunition, and military technology spurred industrial production. The arms industry, which had been expected to suffer from sanctions, instead saw increased demand both domestically and abroad, particularly from countries that remained allies or neutral toward Russia. One of the most pivotal moves Russia made to stabilize its economy under sanctions was pegging its currency, the ruble, to gold. This strategy, borrowed from the United States' historical use of the gold standard, helped Russia maintain the value of its currency and mitigate the effects of inflation. In 2022, Russia made a bold decision to peg the ruble to gold, setting a standard of 5,000 rubles per ounce of gold. Historically, the gold standard was used by many countries, including the United States, to stabilize their currencies. Gold provides a tangible asset that can protect a currency from the volatility of global markets, particularly during times of economic instability. By tying the ruble to gold, Russia was able to shield its currency from the rapid inflation that might have resulted from Western sanctions. This move helped maintain public confidence in the ruble, preventing a collapse that many had anticipated. Russia is the world's second-largest producer of gold, with an output of 324.5 metric tons in 2023, second only to China. Moreover, Russia's gold production is expected to grow by 4% annually until 2026. With vast reserves of gold, Russia had the resources to implement this strategy effectively. Russia's decision to use its gold reserves to prop up its economy proved to be a masterstroke. Gold is one of the most universally recognized and accepted forms of value, making it a powerful tool for economic resilience, especially in a world where many traditional trade avenues had been cut off. While Western sanctions targeted many of Russia's industries, the gold market was notably left untouched. This allowed Russia to continue selling its gold on the global market, circumventing sanctions in creative ways. Key buyers of Russian gold included the United Arab Emirates and Switzerland, countries that did not enforce the sanctions imposed by the West. In 2022, the UAE imported 96.4 metric tons of Russian gold, valued at over $6 billion. Russia's gold exports to Switzerland followed a similar pattern, with Swiss imports of Russian gold reaching $4.87 billion in 2022. The ability to sell gold on the global market provided Russia with a crucial source of foreign currency, helping to further stabilize the economy. Western sanctions were designed to disrupt Russia's trade by cutting off shipping and financial systems. However, these sanctions were not as airtight as initially thought. Russia found numerous ways to bypass the restrictions, utilizing a network of third-party countries and intermediaries that helped maintain the flow of goods and services. Russia's ability to continue importing critical goods, such as semiconductor chips, through third-party networks was one of the most significant examples of how sanctions failed. Western countries, including the United States, targeted Russia's access to advanced chips used in military and consumer electronics. However, Russia found ways to import older, yet still functional components through intermediary countries like China and Turkey. These intermediaries, often companies operating in countries that did not enforce Western sanctions, played a crucial role in keeping Russian industries supplied. Goods were often routed through countries such as Kazakhstan and Armenia, allowing Russia to continue importing luxury goods, technology, and components for its military and civilian industries. Key nations like China, India, and Turkey refused to comply with Western sanctions and continued to trade with Russia. China, in particular, expanded its trade relations with Russia, with total trade between the two countries reaching $240 billion by 2023. This 124% increase in trade allowed Russia to offset many of the losses caused by Western sanctions. A significant factor behind Russia's success in surviving the sanctions has been the broader shift in global geopolitics. The post-Cold War unipolar world, dominated by the United States and its Western allies, is being replaced by a multipolar world, where countries like China, India, and Russia play increasingly significant roles. This shift has provided Russia with the diplomatic and economic flexibility to counteract the effects of Western sanctions. Countries that were previously aligned with the West, such as Saudi Arabia and the UAE, have sought to diversify their alliances, forging closer ties with Russia, China, and other emerging powers. When Western sanctions targeted Russia's access to advanced semiconductor technology, it was expected that Russia's tech industry, and by extension its military capabilities, would collapse. Semiconductors are the backbone of modern technology, from computers to missile systems. Without access to cutting-edge chips, Russia's defense production and consumer technology industries were predicted to stall. However, Russia employed a combination of resourcefulness and geopolitical strategy to overcome this challenge. At the time the sanctions were imposed, Russia's semiconductor industry was far behind global standards. Russian factories primarily used 65-nanometer chip technology, which was about 15 years behind the cutting-edge 5-nanometer chips used by countries like the US and South Korea. In theory, this technological gap, combined with a ban on exporting advanced chips to Russia, should have paralyzed the country's military production and tech industry. Rather than relying on military-grade components, Russia began importing run-of-the-mill computer chips and components found in everyday consumer products. These components, while not as advanced as military-grade chips, could still be adapted for use in certain military applications. Since these parts were not always subject to strict export controls, they were easier to acquire through third-party intermediaries. Russia also exploited a network of third-party countries and traders to obtain components crucial for its military and tech industries. Countries like China, Turkey, and India continued to trade with Russia, and many of these countries became conduits for goods that were either sanctioned or restricted by the West. This illicit trade allowed Russia to maintain a steady supply of necessary components for tanks, missiles, and drones. Despite Western efforts to cut off Russia's access to advanced semiconductor technology, the country's supply of chips rebounded to pre-war levels within a year. This quick recovery was aided by global shifts in supply chains, as well as the growing importance of alternative markets that were willing to continue trading with Russia despite sanctions. One of the most significant ways Russia has managed to bypass Western sanctions is by utilizing a web of third-party trade networks. These intermediaries have played a vital role in maintaining the flow of goods into Russia, even when direct trade with Western countries was severely restricted. Countries such as Armenia, Belarus, Kazakhstan, and Azerbaijan became crucial hubs for goods destined for Russia. Many luxury products, consumer goods, and industrial components that were no longer sold directly to Russia were instead routed through these neighboring countries. This allowed Russian consumers to continue accessing high-end products like Jaguar Land Rovers, Rolls-Royce vehicles, and even advanced technology. For instance, the number of Jaguar Land Rovers shipped to Kazakhstan increased by an astonishing 5,190% since the start of the sanctions. These vehicles were then re-exported to Russia, circumventing the sanctions imposed by the UK and other Western nations. One of the most striking examples of how sanctions were circumvented is the continued availability of Western luxury goods in Russia. Despite the official withdrawal of companies like Rolls-Royce and Bentley, Russian elites were still able to access these high-end vehicles. By shifting their focus to neighboring countries, Western manufacturers were able to continue profiting from the Russian market without violating sanctions directly. Similarly, advanced technology, including smartphones and laptops, continued to flow into Russia. The latest iPhones and MacBooks, which should have been unavailable due to sanctions, were still widely available in Russian stores. Again, this was achieved through a network of third-party countries that re-exported these goods to Russia, highlighting the limitations of sanctions in an interconnected global economy. One of the most important factors in Russia's economic resilience has been its deepening partnership with China. Over the past decade, China has become one of Russia's most important allies, both diplomatically and economically. This partnership has grown even more significant in the wake of the Ukraine war and the subsequent sanctions imposed by the West. Prior to the war, trade between Russia and China was already substantial, but it has exploded in recent years. In 2020, the total trade value between the two countries was $17 billion. By 2023, that figure had surged to $240 billion, marking a 124% increase in just 3 years. This dramatic expansion in trade has been a lifeline for the Russian economy, allowing it to offset some of the losses caused by the withdrawal of Western companies. Half of Russia's oil and petroleum exports in 2023 were sent to China, cementing China's position as Russia's largest trading partner. This energy partnership is mutually beneficial. China secures a stable supply of energy at competitive prices, while Russia continues to generate significant revenue from its oil exports despite sanctions. Russia's partnership with China is part of a broader geopolitical strategy that involves strengthening ties with other BRICS nations: Brazil, Russia, India, China, and South Africa. These countries, which represent some of the world's largest emerging markets, have collectively resisted Western pressure to isolate Russia. Instead, they have continued to expand their economic ties with Moscow. Russia's increasing engagement with BRICS nations has not only bolstered its trade, but also provided it with alternative financial systems and markets that are less dependent on the West. This shift is part of a broader move towards a multipolar world, where power and influence are distributed among several major global players, rather than being concentrated in the West. A significant element of Russia's long-term economic strategy has been its participation in the BRICS alliance, particularly in efforts to reduce global dependency on the US dollar. This de-dollarization movement, championed by countries like Russia, China, and Brazil, aims to create alternative financial systems that are less vulnerable to US economic sanctions. In recent years, Russia and its BRICS partners have been working on developing an independent payment system that would be free from the influence of Western institutions like SWIFT. The goal is to create a system that uses digital currencies, blockchain technologies, and other innovations to facilitate international trade without relying on the US dollar. This initiative gained momentum following Russia's exclusion from the SWIFT system in 2022. By creating a parallel financial infrastructure, Russia and its BRICS partners hope to insulate themselves from future sanctions and create more stable and predictable trading environments. Brazilian President Lula da Silva has been a vocal advocate for reducing dependency on the US dollar in international trade. During a visit to Shanghai in 2023, he questioned why countries must rely on the dollar when conducting trade. His sentiments reflect a growing dissatisfaction among many emerging economies with the dominance of the US dollar in global finance. China, meanwhile, has been one of the most aggressive proponents of de-dollarization. The Chinese government has been steadily reducing its US dollar reserves and increasing its gold holdings, a move that parallels Russia's strategy of bolstering its gold reserves. Together, Russia and China are leading the charge in promoting alternative financial systems that challenge the hegemony of the US dollar. While the war in Ukraine has been devastating in terms of loss of life and regional instability, it has also paradoxically become a significant driver of Russia's economy. Defense spending and wartime production have transformed Russia into a wartime economy where the priorities of the state have shifted towards sustaining the conflict and ensuring economic resilience in the face of ongoing sanctions. Russia's industrial base, particularly in the arms and defense sectors, has experienced unprecedented growth since the war began. Factories that manufacture military hardware, everything from tanks and artillery to drones and ammunition, have ramped up production. This increase in defense manufacturing has provided employment opportunities and bolstered industries that would otherwise have suffered due to sanctions on other sectors of the economy, such as finance and consumer goods. Moreover, Russia has continued to export arms to countries not participating in the sanctions regime, further supporting its economy. While the European market for Russian arms has essentially disappeared, Russia still maintains robust defense ties with nations in the Middle East, Africa, and Asia. Despite sanctions, energy remains Russia's primary economic lifeline. Europe, traditionally Russia's largest energy customer, has reduced its dependence on Russian oil and gas, but this has not led to the collapse of Russia's energy sector. Instead, Russia has redirected its energy exports to other markets, particularly in Asia. China and India have become two of the largest consumers of Russian oil and natural gas, purchasing it at discounted rates. This shift in energy exports has helped Russia maintain steady revenues from its most important industry, even as it loses market share in Europe. Russia's strategic importance in the global energy market remains undeniable. As the world's largest exporter of natural gas and one of the largest exporters of oil, Russia continues to wield significant influence over global energy prices. While Ukraine has received substantial military and financial aid from Western countries, it faces an uphill battle in sustaining its war effort. Ukrainian President Volodymyr Zelensky has consistently called for more arms and funds from NATO allies, as Ukraine's infrastructure and economy continue to be devastated by the war. In contrast, Russia's economy, bolstered by its wartime footing and alliances with non-Western powers, has proven resilient. This disparity between Ukraine's struggling economy and Russia's sustained war effort has given the Kremlin a strategic advantage. Despite international pressure and isolation, Russia's ability to continue funding its military while maintaining economic growth has enabled it to dictate terms on the battlefield. Russian President Vladimir Putin's economic strategy, particularly in the face of sanctions, bears striking similarities to the strategies employed by the United States during times of economic stress in the 20th century. As the global economy becomes increasingly interconnected, the effectiveness of traditional sanctions is being called into question. The dominance of the US dollar, combined with control over major international financial institutions like the IMF and World Bank, allowed the West to effectively isolate targeted countries from global markets. However, the rise of alternative economic powers like China, India, and Brazil has weakened the influence of Western sanctions. These countries, along with other emerging economies, are increasingly able to provide alternative markets and financial systems for countries under sanctions. These developments suggest that the relevance of traditional sanctions may continue to decline as the global economic landscape becomes more fragmented. Russia's remarkable economic resilience in the face of unprecedented sanctions has shocked many in the West. Despite more than 16,000 sanctions targeting individuals, businesses, and entire sectors of the economy, Russia has not only survived, but thrived. Its economy grew by 3.6% in 2023, and it is projected to grow by another 2.6% in 2024. The implications of Russia's survival extend far beyond the conflict in Ukraine. They signal a broader trend in global economics and geopolitics, where traditional tools of economic coercion, like sanctions, may become less effective. As countries like China, India, and others continue to rise in economic power, the ability of the United States and its allies to unilaterally shape the global economy is diminishing. Ultimately, Russia's ability to adapt and thrive under sanctions offers important lessons for other countries facing similar challenges. It also raises important questions about the future of global governance, economic policy, and the balance of power in the 21st century. The era of a unipolar world dominated by the West may be giving way to a new, more complex geopolitical landscape, where economic resilience and strategic alliances play an increasingly important role in determining a country's place on the global stage.